Stock market crash ahead? Even the big banks are turning bearish now. 3 reasons why a stock market crash could be likely. We have been talking about a possible stock market crash for a while in Lombardi Letter. Long-term readers have been warned several times. Our reasons for these calls are very simple. We've listed a few of the biggest ones below. First, stock valuations are too high. They tend to adjust over time and fall back to their historical averages. If valuations do see a reversion to the mean event, we could see a massive stock market crash. Second, stock markets are reliant on economic performance. The U.S. economy could be on the verge of losing its momentum. After the financial crisis, easy money gave the economy a boost, but that's being taken away. With it, the U.S. economy could face headwinds and the stock markets could see a sell-off. Last but not least, risks in the global economy are increasing. Everything on the surface may look good, but problems are brewing underneath. Global worries could cause a stock market crash as well. Big banks turning bearish on stocks now. The big investment houses are sounding the alarms of a stock market crash ahead as well. We are not surprised by this, but it's very interesting, to say the least. For instance, Morgan Stanley, NYSE, MS, came out with dire warnings recently. Regarding the momentum in the market, it said in its notes to clients that there's a breakdown in both legs of momentum. It warned that this phenomenon could be a trigger for a significant market correction. Source: 2 stock market broken legs set stage for significant correction. Morgan Stanley, Market Watch, August 9, 2018. Morgan Stanley talked about Apple Incorporated, Nasdaq, Apple hitting the $1 trillion valuation. Rather than seeing it as a sign that says everything is great, Morgan Stanley said it sure sounds like a ringing of the bell to us. Source: IBID. Bank of America Corporation, NYSE, BAC, another notable financial giant in the U.S., came out with an outright bearish call to action recently. Bank of America literally called for shorting the high-flying FAANG stocks, that's Facebook, Incorporated, Nasdaq, FB, Amazon.com, Incorporated, Nasdaq, Amazon, Apple Incorporated, Netflix, Incorporated, Nasdaq, NFLX, and Google parent company Alphabet Inc., Nasdaq, Goog. Source: short FAANG stocks, BOFA says, Bloomberg, July 28, 2018. While we are at it, know that Morgan Stanley and Bank of America aren't the only big banks that have bearish calls on the stock market. Other major banks have done the same. The list keeps on getting bigger every day. Why do big banks matter? You see, institutional investors, those who actually have a lot of buying power and can move the markets, tend to listen to the big banks' advice at times. If the big banks are turning bearish and calling for a stock market crash of sorts, it could cause institutional investors to panic and sell. As a result, all of a sudden, we could have a major sell-off at hand. Dear reader, my goal is not to scare you. All I am saying is, don't get too complacent. Don't forget, complacency is very dangerous. Don't just look at the bullish case for the stock market. As key stock indices have soared immensely since their lows in 2009, the U.S. economy is facing headwinds, tensions in the global economy are rising, valuations are extremely high, and now the big bank sentiment is turning. It might be time to pause and reflect. I believe capital preservation is very important these days. It doesn't hurt whatsoever in the good times, and, in case there's a stock market crash, it protects investors. How to understand and save yourself from the imminent financial crisis. Debt and buybacks are about to trigger the next financial crisis. At first glance, any observer would consider suggestions that America is headed toward another financial crisis as ludicrous at best and certifiable at worst. After all, the outlook for stocks on Wall Street has hardly looked more optimistic. It's downright shining with glitter and enthusiasm. Even a company like Tesla Inc., Nasdaq, TSLA, which has not posted any recognizable profits, keeps bouncing back every time it gets struck with a dose of market realism. Then again, the Tesla phenomenon itself should be interpreted as a sign of what former Fed Chair Alan Greenspan described as irrational exuberance. Therefore, a financial crisis might be closer than some stock valuations suggest. Yet, a financial crisis is the only logical outcome, even if prospects for the stock market could hardly be better. The problem is that the optimism derives from a single factor: lower taxes. It's only thanks to lower taxes that analysts from all media outlets, as it happens routinely describe the U.S. economy as robust. And it's largely thanks to the lower taxes that, in the first half of the year, many companies reported a strong jump in earnings. You'd be forgiven for having anything short of the most encouraging outlook for companies in the performance of stocks on Wall Street. But therein lies the key to predicting and understanding why all this optimism is misplaced. Investors have been blinded by the myth of a permanent bull market for all of the fabulous earnings forecasts. There lurks in the background an alarming trend that investors are happy to ignore. That trend has a simple and short name: debt. The U.S. government has more debt and will incur more debt because of those same tax cuts that are propping up stocks on Wall Street. That fact alone should advise investors that perhaps the only purpose of the tax cuts was to have averted a financial crisis in 2018. The other warning that's being duly ignored is that the tax cuts have been paying for stock buybacks to the tune of $1 trillion. That's almost 50% more than in 2017. Source: stock buybacks could hit record $1 in 2018, Goldman Sachs, CNBC, August 6, 2018. Stock buybacks might just be the reason the Dow Jones continues to flourish, even if not quite at the pace of January 2018, when it hit over 26,600 points. Apart from public debt, which makes the United States more dependent on foreign buyers of the dollar, raising all kinds of economic and political risks in the process, American corporations and individuals are ever more in debt. Think corporate loans, car loans, mortgages, etc. And debt can cause major problems, especially when interest rates are going up. Frankly, there's no reason for interest rates to go up. The higher interest rates go, the higher the risk of a financial crisis. Higher interest rates have one certain effect. Credit becomes more expensive, and so does margin investing. There's no need for ultra-convoluted financial models here. Both have the effect of reducing risk appetite. Investors will simply turn away from stocks to bonds, treasuries, and less volatile investments. One financial crisis is leading to the next. Few realize that the problem of the 2008 financial crisis was less the crash itself and more how the government responded to the consequences of that crash. Instead of finding ways to help the millions of Americans who lost their savings, encouraging employment, in other words, using the approach that Franklin D. Roosevelt adopted with the New Deal to pull America out of the Great Depression, the U.S. government bailed out the very banks and institutions that created the conditions for the financial crisis. The result was that, without programs to create and sustain employment, many individuals and companies were left on their own. They survived on credit. Quantitative easing, QE, that is, the Federal Reserve's policy of lowering interest rates to near zero, had the effect of encouraging more borrowing. Yet, nothing has really changed in the markets. Many Americans, including many who have yet to enter the workforce, that is college students, remain overloaded with debt. Rising interest rates will encourage investors to close their stock positions and avoid getting stuck with a margin call they won't be able to pay. Meanwhile, corporations took advantage of QE policies to borrow in order to grow. Junk debt has shown its ugly face. This is not a criticism of QE necessarily. Rather, it's a criticism of the markets that have failed to realize the difference between real profit-driven growth and debt-driven growth. More significantly, the big institutions are back at it. They have not learned their lesson, because instead of being handed a bloody nose in September 2008, they got the almost $1 trillion bailout nobody else could even dream of securing. Collateralized derivatives, or some such named products, are back in vogue. These are investment vehicles that are based on debt. They are collateralized loan obligations, CLO. And some investors like them this year since CLO are at record high demand. Source: the junk debt that tanked the economy? It's back in a big way. The Washington Post, July 25, 2018. It's no exaggeration to suggest that the entire U.S. economy risks falling victim to one giant default. Higher interest rates intensify the debt burden. Debt is the biggest risk facing investors. A stock market correction now could easily turn into a stock market crash and a deep financial crisis with devastating outcomes. The higher the level of debt, the higher the risk. There's no way around it. Excess debt is always the cause of financial ruin at the individual, government, or corporate level. A market on steroids. And the problem of stock buybacks. In practical terms, while there are no risk-free propositions in finance, some stocks are more vulnerable to debt than others. Avoid stocks based on high leverage transactions. Big leverage means big debt. Thus, be wary of AT&T Incorporated, NYSE, T. Once a staple for investors interested in longevity and reliable returns, AT&T has gone to the dark side after buying Time Warner in June 2018, pushing debt to almost $200 billion. Also be wary of any of the big corporations that propped up their stock values in 2018 using the aforementioned tactic of buybacks. If they're buying back, the managers are less interested in the long-term health of the company and more in the value of their stock options. Some of these will surprise you. For example, beware of Apple Incorporated, Nasdaq, Apple. The world's first trillion-dollar company it may be, but the way it got there is less than, shall we say, ethical. It was the most enthusiastic participant of the stock buyback game of 2018. Source: Apple's stock market scam, The New Republic, August 3, 2018. And the Trump tax cuts and capital repatriation scheme has accelerated and exacerbated this phenomenon. Apple is not selling more iPhones and Macs. Thus, that stock price does not reflect a true indicator of performance. Rather, it's a stock market on steroids. And it's not just Apple. McDonald's Corporation, NYSE, MCD, has been growing less because of Big Macs and more because of buybacks. Source: Companies keep buying back stock. Bloomberg, July 9, 2018. Investing and staying in the markets has become a pernicious task, full of potential pitfalls. It's important to think in the way described by the overused phrase, outside the box, quite literally. Adopt a strategy or a theme. Invest in companies that have the potential to last, or those whose stocks correspond to a specific socio-economic trend, which provides a lens, or logic, through which to gauge their performance. Many companies are borrowing to merge, acquire, and simply survive. More often than not, corporations are taking out loans to perform buybacks. Thus, beware of stocks that are just too bullish. Soon, they won't be. Low interest rates encouraged borrowing. The Fed's gradual lifting of rates may have triggered the last major bout of borrowing before rates increase. Except, sooner or later, the debt will have to be repaid at a higher rate. That never fails to cause a financial crisis. Bond market is headed down a dangerous road. Bond market faces headwinds and a lot of uncertainty ahead. The bond market shouldn't be ignored. It could be heading toward immense trouble, and that may create a lot of uncertainty in the coming months and quarters. You see, investors at times ignore bonds, thinking that the bond market doesn't impact them whatsoever. Don't be one of those investors. Bonds could be headed for a crash, and that could take a massive toll on investors' portfolios. Remember, when yields decline, it means that prices are going higher. Why did bonds have a rally over the past 30-plus years? The U.S. Federal Reserve and other central banks across the globe are lowering their benchmark interest rates. Keep in mind, when interest rates go down, bond prices increase and yields decline. Don't forget, the opposite is true as well. When interest rates go up, bond prices decrease and yields skyrocket. In 2008 to 2009, we were faced with a financial crisis and a global economic slowdown. As this was happening, central banks went all in. They dropped their interest rates faster than normal, and this acted as throwing more gas on the fire. It gave a major boost to the bond market. Central banks raising interest rates fast forward to now. As it stands, we are living in an environment where central banks are raising interest rates. This is mainly because economies are doing fine and, in some cases, inflation is taking a toll. The Federal Reserve is at the forefront. It's raising its benchmark interest rates. Consider this, not too long ago, the Federal Reserve had its benchmark rates set at 0.25%. They stand at 2% now and they are expected to be above 3% by 2020. We are seeing a panic-like scenario in the U.S. bond market especially. The chart below shows the yields on 2-year U.S. bonds over the last 2 years. In August 2016, yields on 2-year U.S. bonds were around 0.7%. Now they stand close to 2.7%, their highest level since 2008. Using simple math, the yields on short-term U.S. bonds have soared by over 280%. It can't be stressed enough, yields rising fast suggests that bond prices are tumbling. Why should an investor care about the bond market? I completely understand, some investors may not have any bonds in their portfolios. but it doesn't mean they should ignore bonds. You see, if the sell-off of bonds continues, it could also lead to a sell-off of stocks. How so? At times of panic in one market, investors usually just sell everything and run for the exit. Therefore, the stock market could come under fire as well. Beyond this, know that bond yields affect the interest rates on a lot of things. For example, mortgage rates are highly correlated with 10-year U.S. bonds. If 10-year U.S. bonds sell off, it could mean that mortgage rates will soar. Home affordability will go down the drain. Furthermore, pension funds own a lot of bonds. In the U.S. economy, we already have a retirement crisis. As I see it, a tumbling bond market could only make things worse. If you are not watching that market, you could be making a big mistake.